So we're going to look at Brookfield Asset Management. And what we're going to do in this video is we're going to go through the process for valuing a company. We're going to enter their financial information into the model. Then we're going to calculate the future free cash flows of that company, discount the cash flows back to today's dollars. And then we'll have an intrinsic stock price and compare it to the actual stock price to see if it's a buy or a sell. And then at the end, we're going to look at the financial ratios and compare those to its competitors. So Brookfield Asset Management is an alternative asset management company, focuses on real estate, renewable power, infrastructure, and private equity. It's headquartered in Toronto, but has offices in New York City, London, and Rio. And it was founded over 100 years ago in 1899. So let's start with the model. We need the market cap, $53.9 billion. So it's a decent sized company. Stock price is 34.33. And then we'll enter the financial information. We'll start with cash flows. And the free cash flows for 4 years. And free cash flow is operating cash flow minus capital expenditures. So it's the cash that's left over after operating a business. And I don't think that many people focus on free cash flows, especially new investors. But if you think about buying a new company, like if you were to buy, say, a small business, none of us could buy a company like this or a company that traded on the stock exchange. Warren Buffett can, but not us. But say you bought a small company. You would want to know how much cash that company generated after it paid its expenses, right? If the owner said it generates $50,000 of cash after it pays its expenses, then you know I'm going to be making $50,000 a year if I can match what the owner did. You might do better or worse, but right now the current owner is generating $50,000 of cash. So a lot of stocks are generating negative cash flow. And I'm not saying it's a bad thing, because when you grow, you might have to invest in your company. All I'm saying is that might be a red flag, especially for a company that's been around a while, or if it doesn't have an outlook that's going to be positive in the future. Why would you want to buy a company that doesn't provide any cash? You wouldn't. If the small business you wanted to buy said, oh, it doesn't generate any positive cash. After expenses, I lose $50,000 a year. You'd be like, okay, so I'm not interested in the company. The same thing with a stock. If there's no free cash flow left over, just why would you want to buy it? Unless you really feel they have such a great, unique product like Tesla or one of these startups that it's going to really grow a lot and be worth a lot of money in the future. So we have all the financials entered, the net income and total revenue. So we need a capital structure of the company to figure out the discount rate we need to apply to the future cash flows. And they pay $7 billion on their debt. Let's see how much debt they have. No current debt, which is good. $143 billion of long-term debt. And let's see their tax rate, because interest payments are tax deductible. So they pay the income before taxes $5.8 billion and $500 million in taxes paid, so 8.5% taxes. So their cost of debt it brings it down to 4.6%. It's still a kind of a high rate, but that's what they pay on their debt. So it's a big payment. Every year they pay $7 billion of interest on the debt. Imagine paying $7 billion of interest on your credit cards. Obviously you couldn't afford that, but that's a big number to pay. They are a big company, so let's keep going. So their beta is 1.13. The stock moves a little more than the market. They have a lot of debt, 73%, so that's not a good sign. So the weighted average cost of capital is only 6.4% because it's a combination of cost of equity and cost of debt, and they have so much debt, so it's weighted closer to the debt. But they do get a haircut on their terminal value based on the debt they have. So they have that working against them. So that's 6.4%. Let's discount the future cash flows. So the future cash flows, it looks like they look pretty high compared to what they actually were. Let's look in, it says it's expected to have, the model at least is forecasting $87 billion of revenue next year in 2020. Let's look in the analysis section in Yahoo Finance. Let's see what they're saying revenue. So they're saying revenue is $38.72 billion. I think because of coronavirus, they're expecting a negative 43% sales growth. Let's use their number because I'd rather be more conservative on the model than more aggressive. I like to just change the color so I know it's so I think this gives us a more conservative estimate of the company. And now the future cash flows are probably more in line with the past. The reason they were having such aggressive cash flows in the future is because their growth was so aggressive the past 4 years. And I just don't think that's going to happen because with coronavirus, everybody's struggling, especially an asset manager. So I think this is a better indicator of the company. So we have 4 years of estimated free cash flow. Then we did a terminal value, which is all years past year 4. Then we discounted those numbers back to today. We have a value of the company of $37 billion. And when we divide that by 1.5 billion shares, we get an estimated intrinsic stock price of $23.50. It's trading at 34, so it's trading at a 46% premium. So it's a sell according to the model. So it looks like it was trading in the 20s a year or two ago, and it did drop when coronavirus hit. It's come back up a little bit. So obviously the stock price just is based on supply and demand of the market. The more people that want to buy the stock, the price goes higher, and the more people that want to sell the stock, the price gets lower. But you have to look at indicators such as the financials and other external factors like competition, inflation, and also market sentiment. This could all change the value of the stock. Even if a company is doing well, people may not feel the future is going to be strong for the company, or they just don't feel that particular industry is a good industry to invest in. So the only way to mitigate these factors is to hold the stock long term, and that will reduce any ups and downs if you do invest in a company with solid fundamentals. Let's look at their financial ratios. We need some more information. And we got to go back to the balance sheet. And let's get their current assets. $42 billion. Current liabilities. $45 billion. Stockholders' equity. And then their operating income, which is $15 billion. So let's look at their ratios. They have an okay PE. I like to see under 15. 19 is not terrible. That's price of the stock over earnings per share. And they might have bought back a lot of stock. This seems like a company that would do that. So they might have lowered, you get a lower PE when you reduce the number of shares outstanding. Price to sales is really good, 0.8. I like to see under 2.2. That's price over stock. That's stock price over sales per share. They do have a good price over book, 1.5, but I would definitely look at their balance sheet to confirm what assets they have. They don't have a good current ratio. It's under 1, which implies they don't have enough liquid assets to fund their day-to-day operations. So they may need to go into a little more debt. It's not that far below 1. It's pretty close. But current ratio is current assets over current liabilities. And current assets is like cash, accounts receivables. And current liabilities is accounts payable and current debt. So it is important that they get this over 1. And they have so much debt, they don't have that much room to borrow. ROE is pretty low, 8%. I like to see above 20% when investing in a stock. Let's look at their interest coverage ratio. This is a good indicator of default risk, because what it is I'll show you. It's your EBIT, which is your operating income, divided by your interest expense, the interest you pay on your debt. So they can cover it twice, the interest coverage ratio. So that's not a great spread. I mean, it's not too bad. At least they can cover their interest payments. But if you think about it, their earnings of the whole business are $15 billion. And half of that is going just to pay their debt, the interest on their debt. So that's not a good sign. They don't have much cushion for other expenses. And this is operating earnings, so it's after you pay your everyday operations, your employees, things like that. But still, there could be other things they need money for, like if possibly investing in another office, or if another, you have a struggling year. So it's a little high, or a little weak, I should say. Now let's look at the ratios. And I have three other companies, Atco, BlackRock, and Turn, that I can compare them to. So the PE is pretty good for everybody. I mean, Atco and Turn have really good PEs. BAM has the best price to sales ratio of 0.8. BlackRock is kind of weak in that category. Price to book, they're all good in price to book. I think that's just how the business is. Current ratio, Atco is really struggling in that category, and BAM a little bit as well. And the ROE, they're all a little low on ROE. Debt, BlackRock and Turn are in good shape with debt. BAM and Atco are a bit high. BAM is definitely on the high side. But BAM is a big company. You can see the market cap. It's a $53 billion company. BlackRock is the giant of those four. And then Turn is just a little baby company. So it's hard to compare. I mean, the ratios do make things equal, but it is hard to compare a little tiny company to these big giants. Atco isn't too big. But BAM is a big company. It's been around 100 years. So there seems to be a little risk with the numbers. Let's look at so there's 15% chance of a default within 12 months. That's just based on my calculation. This was my own personal calculation. And it may change. But I base it off of a few things. That market cap, free cash flow, interest coverage ratio. So they take a hit on interest coverage ratio and debt because they're not too strong. So let me know what you think in the comments. This was an interesting company to look at, and thanks for watching.